MoneyShow is delighted to welcome back Peter Schiff, Chief Economist and Global Strategist of Euro-Pacific Capital. Mr. Schiff has been quoted hundreds of times in leading news outlets around the world, and he regularly appears on business news channels worldwide. Peter, thank you so much for joining us. The floor is yours.
Oh, thanks a lot for inviting me to the Money Show again. And as I stated a bit yesterday on the panel, all right, just shutting off a computer distracted me. I was asked a question by Brian London, I think it was the first question, was really why has gold and gold mining stocks, why have we not seen a bigger reaction given the unprecedented monetary inflation that has been unleashed since the beginning of the COVID pandemic? We are looking at budget deficits that dwarf any of the deficits of the past. I mean, it's not even close to the deficit spending in the aftermath of the 2008 financial crisis. We are several orders of magnitude larger than that. And there is no end in sight to these deficits. And in fact, if you look at the political landscape back in 2009, 2010, we had just sent the Tea Party to Washington in 2010, and they were there to put a stop to the deficits because there was some outrage by the size of the deficits that Obama signed on to, even though George Bush kind of got it rolling because he was in favor of the bailouts and TARP and all that response, which started the deficits, jumping. But when Barack Obama continued and expanded those policies, there was some pushback on the part of at least Republicans to this profligate deficit spending. And so there were some breaks. Remember, we had, the sequester, and we had the battle over the debt limit and the government shutdowns, because this was all at least a feigned attempt to put some kind of an end to the deficit spending. Well, fast forward to today, and we're not even pretending that we care about these deficits. There is no Republican opposition to these Democrat deficits. In fact, the Republicans were cheerleading the deficits when Donald Trump was president. We intentionally reduced taxes and increased spending under the Republicans. Donald Trump signed on to budgets that increased military spending and that increased welfare spending while simultaneously reducing the revenues to pay for all that spending. And we intentionally made the deficits much bigger. We hit record highs, eclipsing really the deficits following the financial crisis prior to COVID. Then, of course, when COVID hit, the deficits just went off the charts. But now, with Biden at the helm, the Republicans are not even in a position, if they wanted to oppose these deficits without being hypocrites. And so they're not doing it. And in fact, we now have a theory that deficits don't even matter, that they could be as large as we want, and there's never going to be any consequences. In fact, we're saying the same thing about money printing. Look at what Jerome Powell recently stated about the relationship between money supply and inflation. He said that it no longer exists, which is laughable because inflation by definition is an expansion of the money supply, even though a lot of people incorrectly define it as prices going up. Prices going up are a consequence of inflation. They are not inflation itself. But even Milton Friedman described inflation as always and everywhere a monetary phenomenon. Well, now Jerome Powell is saying inflation has got nothing to do with money. We can print as much money as we want, and history has proven, at least recent history, that there is no effect on prices. So in other words, we can create all this inflation, but there's no inflation. That is what Jerome Powell believes. And why does he believe that? Well, he is looking back over the past 10 or 20 years and seeing this big increase in debt and money supply, but not a commensurate increase in the CPI. The way the government measures inflation, it's still below 2%. And so the Fed now believes that because they were able to run these big deficits and print all this money, and they haven't had an inflation problem. In fact, in the Fed's mind, the problem with inflation is that we haven't had enough of it, that they've wanted more inflation and they haven't been able to succeed. And so if we failed at getting inflation up to 2% in the past, well, they still think they're likely to fail. That even though the amount of money that they're printing now and the size of the deficits that money printing is financing dwarf what was going on, in the prior couple of decades, they still think that we're not going to have the consequences. And they think that our recent experience has basically proven that out. So the Federal Reserve is not worried about inflation and money printing. Nobody in government is concerned about the size of the deficits. We have now a new administration, the Biden-Harris administration, or Harris-Biden, depending on your perspective. But they have a whole agenda of socialist programs that they want to enact, and they no longer feel constrained by the need to pay for them. Because after all, we can have anything we want as long as the Federal Reserve provides the money. Now, of course, they are talking about paying for some of it by taxing the rich, right? But that's probably more class warfare and punishing the rich than it is about paying for their programs, because the tax increases that have been proposed won't even come close to covering the costs. In fact, the last several stimulus packages that we had, including the most recent $2 trillion package that just passed, there was no tax increases that accompanied that increase in spending. So it's 100% financed by debt and inflation. But Biden is now preparing another stimulus. I'm not sure the size of this one for infrastructure or however they want to describe things as infrastructure. It's now kind of a catch-all term for whatever the government wants to spend money on is now called infrastructure. But they are talking about marrying the infrastructure spending bill with some type of revenue bill aimed at taxing the rich. But again, these taxes are not going to come close to covering the costs. Most of the costs are going to be borne through inflation. The Fed is going to print money, and that money is going to be spent into circulation rather than redistributing the tax money. They are just going to introduce new money into the economy. But of course, when the government prints money and spends it into circulation, that money is not tied to any additional productivity. So there's no additional goods and services. We just have additional money to spend, bidding up the price of those goods and services, which is why prices end up rising as a result of the monetary inflation. So you have really this perfect storm that is developing right now that should be extremely bullish for gold and gold stocks. You have massive money printing that is only going to get bigger and bigger without any opposition coming to the deficits. And the taxes that are going to be increased, they are actually inflationary as well, because the tax increases are aimed at producers, not consumers. The rich people that are going to be paying these taxes, they're not going to be reducing their consumption in order to pay these taxes. They'll be reducing their investment, because it's the investment dollars that get taxed. That marginal money that would otherwise be saved and invested ends up getting sent to the government. So very wealthy people, just because they're paying more taxes, it doesn't mean that they're going to have to cut back on their lifestyle, because most very wealthy people only spend a small portion of what they earn. The rest of it is invested in enterprises that grow the economy, that add to the production of goods and services, that create jobs. It's that investment that ends up being curtailed in order to fund the tax payments. So, that's going to result in less output, less real economic growth, and more money printing. In addition to that, we are also now talking about wide-scale student debt forgiveness. And a lot of people are overlooking the inflationary aspects of that. Because if we have $1 trillion of student debt, and we have a lot more than that, but let's just say we forgive $1 trillion worth of student debt, that's $1 trillion that those students were supposed to return to the US government, right? Or return to their lenders. Now, if the debt is forgiven and it's private debt owed to a bank that the government has guaranteed, if the government tells the student, hey, you don't have to take money out of your paycheck and pay the bank that loaned you the money, the government is going to print the money. The Fed is going to print the money and give it to the bank. So the money supply has to be expanded every time a student loan that is owed to a private lender is forgiven, because the government guaranteed that debt. And so if the student doesn't pay it, the government will. And the government's not raising taxes on other Americans to cover those forgiven loans. So the money's just going to be printed. Now, if the lender is the US government, if the US government directly loaned money to US students, well, US students were supposed to pay that money back. Well, now if they're not going to pay that money back, well, that's inflation too, because money that was going to be transferred back to the government now remains in the private sector. So all of this student loan forgiveness, unless they're talking about a specific tax increase to cover the cost, which they are not, it all amounts to massive inflation. And now, of course, the former students who are now relieved of the obligation to repay the money they borrowed to get their worthless degrees, they now have more money to buy goods and services, right? Well, they didn't produce more goods and services, but they're going to consume more goods and services. And all of this is evidenced by our skyrocketing trade deficits. It's not just that we have the biggest budget deficits in history, we have the biggest trade deficits in history. In fact, our most recent merchandise trade deficits was an all-time record high. Americans are importing more, but we're not actually exporting, because a lot of the people aren't even working. And you need to produce products before they can be exported. And a lot of people are looking at this booming US economy, and they're not realizing that it's not the economy that's booming. It's consumption and spending. That's where the boom is. But what is making this boom possible? It's overseas economies that are producing all the stuff that we're consuming, and they're putting it on ships and sending it to the US. That's why the ports are backed up. They've never been so congested. And the cost to ship goods into the United States, I don't know what it is, 5 times or something like that higher than the cost to ship goods out of the United States. And in fact, almost all the containers that are leaving the US are leaving empty, because they're just being sent back to Asia so they can be loaded up with more consumer goods and sent back to America so Americans can buy more stuff that they didn't produce. So this is not economic strength. This is a massive inflationary bubble. So given this unprecedented amount of debt, trade deficits, budget deficits, unprecedented amount of money printing, and zero opposition from anybody, and looking at the fact that we're just getting started, that these massive deficits that we're looking at today are going to get bigger and bigger tomorrow. The difference between now and earlier, like following QE1 or QE2, is that the markets incorrectly believed that that was temporary, that those were emergency measures that would never be repeated again. Now, of course, I was sounding the alarm back then. I was saying Bernanke was lying, that this was not a temporary measure, that it was a monetary roach motel. We had checked in, we could never check out. We'd have more QEs than Rocky movies. We'd have QE infinity. The markets didn't believe me, they believed the Fed. But now the Fed is not even really trying to pretend that this is temporary. I mean, this is a permanent source of government finance. This is not abnormal. 0% interest rates are the new normal, right? And the deficits that we have now, they're not some temporary way to get us through a crisis. We're now permanently relying on those deficits, which have to get bigger and bigger and bigger as time goes by. And if you look at what we're doing now with these extended unemployment benefits, we are incentivizing millions and millions of Americans not to work by providing them with more money to not work than they would earn if they returned to work. Now, people aren't stupid. They are going to respond to these incentives. And so they're taking them up on their offer, and they're not working, and they're enjoying their paid vacations. Well, where is the money coming from to pay them? The Fed is creating it. Are these vacations going to end? No. I don't see the politicians in Washington now telling voters who are on these extended paid vacations that the vacation is over and it's time to go back to work, especially when they can bring out the excuse that keeps on giving, and that is, well, I don't want to get COVID. I'm worried about getting COVID. I mean, look, I'm here in Puerto Rico. The schools opened up for about 2 weeks after all of the teachers in Puerto Rico got vaccinated, right? They were the first in line to get vaccinated so we could reopen the schools. And then all of a sudden, supposedly there's a spike in COVID cases. And despite the fact that all the teachers are vaccinated, the schools closed down again, and they're probably closed again for the rest of the year. What was the point of vaccinating them if we have to close the schools? The problem is the teachers don't want to work. They'd rather get paid. They know if they just stay home and claim their word about COVID, even though they're vaccinated, even though the kids are all wearing masks. The kids were going to school with masks. The teachers were all vaccinated, and they said, nope, we got to close the schools. And the teachers are probably happy about it. But this is probably going around all over the country. People have an excuse not to work, and they get paid more money not to work than when they were working. And of course, when you don't have to work, you avoid a lot of expenses, like commuting back and forth to work, like having to maybe eat lunch out or having to send your clothes to the dry cleaner, and you get all this leisure. You don't get paid for your commute time. That's non-compensated. So this is a huge gravy train that Americans are going to be on for as long as the eye can see. So again, all of this, right, is the perfect storm. I have never seen monetary and fiscal conditions so inflationary in my life and so bullish for gold and silver, yet the markets are yawning or shrugging it off. So the question is why? Right? Well, some people want to say, well, it's because gold and silver have been replaced by Bitcoin, right? That's why we're not seeing gold, silver prices going up, because nobody wants gold anymore. It's worthless because now we have something better, right? We have Bitcoin, we have gold 2.0, and that is the digital version. And so who wants analog, right? Like somehow gold is like a landline and a Bitcoin is a cell phone, right? So why would you want to be locked to a landline when you can have a cell phone, right? Of course, all of these comparisons are false. It's all meant to drive more money into the Bitcoin pyramid scheme. But I do not believe that the reason that gold is not rising is because of Bitcoin. I think that the reason Bitcoin is rising is because gold is not. I believe that that is the case. I believe that the fact that gold has disappointed a lot of people by not rising more, I think that has caused some people to move into Bitcoin, but I doubt those flows are large enough to have a meaningful impact on gold. But they are large enough to have a meaningful impact on Bitcoin, especially given how illiquid the market really is and how heavily concentrated the Bitcoin is in the wallets of, a few of these whales. So the market is easy to manipulate. And I think the Bitcoin crowd is able to successfully convince some people that Bitcoin is the new gold by pointing to the fact that gold has not delivered on some of the expectations. and that you see this validates Bitcoin. But I think the real reason that gold has not made a bigger move is, one, it's already made a move. I mean, it's not like gold hasn't gone anywhere. Gold last year made a new all-time record high. It was above 2,100. So that was a big move. And so a lot of what we're seeing now did get priced into gold at that time. And now, like markets typically do, gold had a correction. And corrections are normal in a bull market. In fact, they are necessary in order to shake out a lot of the weaker players. And that's exactly what's happened. I think in recent months, you've seen some people throwing in the towel. Some of the people that rushed into the gold market on the run up to 2,100, I think these people have maybe already exited their positions. Some of the people that rushed into some of the gold stocks during that time period have probably got discouraged and have probably sold out. That's part of a bull market. That's what they do. In fact, I think even some of the diehard gold bugs have kind of resigned themselves to the fact that this correction is going to be deeper and longer lasting. And so we have to hunker down and ride this out. So I think that there's a big wall of worry that has been erected in this market. So I do think that gold has gone up. It's now pulled back from those record highs. And I think it is basing for another move higher that is going to be much, much higher than the 2,100 that we got last time. But I think the main reason that you're not really seeing this big institutional push into gold is because the big money still doesn't get it. They still believe the Fed, right? Just like they believed the Fed back in 2005 and 2006, when they said, don't worry about the problems in subprime, they're contained. The markets believed the Fed. The Fed was wrong, and the markets were blindsided by the 2008 financial crisis because they believed the Fed. Now, there were people like me who were out there saying, hey, the Fed is wrong. The problem isn't contained. We're going to have a financial crisis. But my voices were ignored or drowned out by, the voices of, the more prominent people that are part of the establishment and the Fed itself. Well, I don't think the mainstream has learned anything from the mistakes of the 2008 crisis. You now have this huge inflation problem that's obvious, that's to me more obvious than the financial crisis was back in 2006. And the same group of people who are oblivious to that crisis are oblivious to this one. And you have the same Federal Reserve, although a different chairperson, but now basically saying, hey, don't worry about what you're seeing with consumer prices or producer prices or import-export prices. Don't worry about money supply. Don't worry about all this stuff where you're seeing this massive increase in prices. It's all transitory. Nothing to be concerned about, right? Just like the subprime problems, no big deal. It's just confined to a certain small segment of the housing market. It's not going to affect the broader market. Of course, it'll never affect the economy. So just ignore that. Don't worry about it, right? And the markets did, and they got burned. Now, of course, they got bailed out by the very institution that told them there was nothing to worry about, but they didn't learn from their mistakes. Maybe because they got bailed out. Maybe had they not been bailed out, they would be a little bit, more concerned now about getting burned. But now here you've got the Fed telling people, don't worry about all this inflation because it's just transitory. And even if we're wrong, even if the inflation is not transitory, well, we'll just stamp it out, right? I mean, normally the Federal Reserves of the past have been preemptive, right? They've said, oh, we need to prevent inflation before it happens. We need to try to forecast inflation and get out ahead of it, right? Well, hey, now the Fed is saying...
I just wanted to let you know we just have a few minutes left. If you'd like to do Q&A, I know you want to finish up your point now, but...
Gee, the time really flied. So no, I won't have time for Q&A. Okay. The Fed had convinced everybody that subprime was contained. And so the market believed them. I may be backtracking a bit, but now Wall Street is convinced, now I remember, not only about inflation being transitory, but that the Fed can put out the inflation fire when it gets started. In the past, the Federal Reserve tried to forecast inflation before it happened and do something to prevent it. What Powell is saying now is, look, we're not going to do that. We're just going to wait until inflation becomes a problem because we can easily solve it, because we have the tools to solve an inflation problem once it really takes hold. So we're not going to try to preempt inflation. We're going to wait until it's a problem, and then we'll quickly solve the problem because we have the tools. But what they don't get is there's an old expression about inflation: you never let the genie out of the bottle. And the reason is because it isn't that easy to put the genie back in. And in fact, it's going to be more difficult now, in fact, impossible relative to what it was in the past, because we have so much more debt now. The economy is a much bigger bubble, because the only way the Fed can fight inflation, if it waits until it gets really high, is to jack interest rates way up and to abruptly shrink its balance sheet and contract the money supply. Well, once you get an economy completely addicted to monetary heroin, how do you go cold turkey? Take all the heroin away from the economy, right? You can't just prick your own bubble. So it is complete nonsense for anybody to believe that the Fed could let inflation get to 4 or 5 or 6% and then raise interest rates to 10% in order to bring it back down. We couldn't even raise interest rates to 2.5% in 2018, and before the market started to fall apart. So I know I don't have a lot of time. So the bottom line is, people believe the Fed when they say that inflation is transitory, and they also believe the Fed when they say, even if it's not, we will fight the inflation and bring it back down. So because nobody is worried about inflation, despite all of this data that should have them scared, the daylights out of them, they should be completely worried. They're extremely complacent. And so that's why they're not buying gold. It's like they don't think they need the insurance policy, so they're not buying it, right? But at some point, people are going to wake up to this reality. They are going to realize that the Fed is lying or bluffing or whatever, that inflation is a much bigger problem than the Fed admits, that this is not transitory. This is the beginning of a much higher period of inflation, that we're actually catching up to all the inflation that we have avoided. There was a bigger lag between all that money printing and consumer prices going up. So we're catching up to the inflation of the past, but now we're hitting it into a whole new gear with all the inflation of the future. So inflation is not transitory. It is permanent. It is going to get worse. And the Fed can't do anything about it. There is no way the Fed can cure this disease, because in the Fed's mind, the cure will be worse than the disease, so they are never going to administer it. And so once the investing public, the bigger money, right, not the small guys that are listening to me talk now, because we don't have enough money to make a difference. But when the big money, institutional money, pension funds, endowments all around the world wakes up, because right now they're asleep, they don't perceive the threat. When they recognize how bad the threat really is, that's when they're going to be buying gold. That's when these gold stocks are going to take off. But from an investment point of view, we have a gift horse right now with respect to the opportunity to continue to buy these stocks, because we possess information that the majority of investors just don't have. I mean, it's not like it's insider information. It's there. It's just they don't understand it. They don't know how to interpret it. They're wrong. Just like they didn't understand what was going on before the financial crisis, and just like they got blindsided by that crisis and would have lost a ton of money but for the government, they're in the same position today. There were people who were shorting the subprime market, myself included, because we understood the problems that most people didn't. Well, these are bigger problems, and the same people that didn't understand those, they don't understand these, and they're not prepared. But we have this window of opportunity. Don't know how much longer it's going to be open, right, to load up on these gold mining stocks. And personally, I think the best way to do that is through my gold fund, the Euro Pacific Gold Fund, which is managed by Adrian Day. Adrian is also presented at this conference. He was the moderator of the panel last night, but I think he's the best in the business. He's a bit of a modest guy, but I don't think there's anybody that equals him when it comes to his understanding of the mining sector and his stock picking. So I think we've got a great portfolio of gold mining companies. And before the rest of the world wakes up, you want to make sure and get yourself positioned. So, you can buy the gold fund at any of the discount brokerage houses, your Schwab, Fidelity, any of these companies. The funds are on the platform. You can also work directly with representatives of my firm, Europe Pacific Asset Management, Europe Pacific Capital. You can see the URL above my shoulder for the asset management company. It's europacfunds.com. You can also go to Europe Pacific Capital, europac.com, and talk with my brokers about the gold fund. We also have separately managed accounts where Adrian will manage your portfolio in individual gold stocks. So rather than being part of the mutual fund, you can have a separately managed account where Adrian will buy, and personally develop your gold portfolio.